everyone, welcome to another episode of In Conversation by Advisor Coach. Today in conversation, our guest is Mr. Pratik Oswal, Chief of Passive Business for ETFs as well as index funds. Pratik has a wide working experience across hedge funds, private equity, investment banking. Prior to his current responsibility, Pratik was in San Francisco, working as the head of operations and finance with a fintech startup company. Welcome, Pratik, to In Conversation by Advisor Coach today.
Thanks for having me. Looking forward to our conversation.
My pleasure, Pratik. So, Pratik, in the past, we've seen actually that the index funds have actually gained a lot of popularity, right? They have gained a huge momentum. We've seen huge amount of inflows coming in as well as the AUM's growth. What do you think are some of the reasons behind that?
Yeah, I think index funds in general, index funds, ETFs have got a lot more awareness over time, especially in the last 5 years. So I think it used to be about less than 1% of the overall industry about 7-8 years ago, and today it's close to 17% of the industry in terms of market share. So I think majority of this is dominated by pension funds. But even if you exclude that, there's a lot of interest coming in from investors who are now looking at ETFs, index funds for their allocation. I think the biggest reason is just awareness. I think index funds and ETFs have really people are starting to know about what they are and how they work. That's number one. Second is a lot of investors are now coming directly and buying stocks, buying ETFs, buying funds. So I think as more and more people buy directly, they tend to also look at index funds as an option. So that's one big reason to why people are looking in this space. And third is, the categories also become a lot more, more efficient, more streamlined. If you look at index funds 5 years ago, when we first started, they're very inefficient. I would not, advise anyone to buy index funds. But today, tracking errors are very low, tracking differences are very low. There's a lot more options. Before, there was only one option, two options, Nifty 50 and Sensex. Today we have ETFs, index funds across all different asset classes. You have commodities, gold and silver, international, you have mid cap, small cap, micro cap, sectors, themes. So essentially the entire bouquet of index funds, ETFs have grown significantly. And that has also led to, I think more and more offtake of this category.
And if you could just elaborate a bit more between the individual investors' participation within the index as a category and the ETFs as a category, what's your observation around it?
So, I think if you look at index funds versus ETFs, ETFs tend to be favored by, the sort of traders who want to, buy and sell on a short-term basis, but also they are favored by institutions and family offices. They tend to like ETFs because they buy baskets directly from the AMC.
Sure.
But if you look at the majority of the investors who invest in passive funds, they come through index funds route. Index funds, where you can set up SIPs, you don't have to worry about liquidity on the exchange. It's a mutual fund format. Buying and selling is much easier. So overall, what we've seen is that unlike the US, where there are tax advantages of buying ETFs, India, where there's not much advantage. In fact, index funds offer a lot more simplicity. So generally, index funds tend to be a lot more popular than ETFs.
Yeah, definitely. So currently, as we speak, you have the Motilal Oswal Nifty India Defense Index Fund NFO running. Could you provide some more insights into the fund?
Yeah, so essentially, if you look at Motilal Oswal Asset Management Company, we have a lot of funds that we've launched over the years. I've personally launched about 30 funds. And we've launched funds across categories, caps, your multi-cap, small cap, large cap, factor funds, sector fund. This is the first thematic fund that we've launched in the index category. And we're very excited because we believe that this is a good fund for anyone looking at long-term wealth creation. Also, anyone who's has a slightly more higher risk profile, would like this fund. So essentially, it's a fund that aims to replicate the Nifty India Defense Index, which is essentially a pure play into defense as an industry. Defense has been in the limelight, has been in the news over the last few years. There's been a lot of stocks that have got a lot of traction. And we believe that there are a lot of investors who are looking for solutions in this space. And this is the first one that we think is a good solution for anyone looking to get exposure to this space, which is growing very quickly. So that's what the fund is all about, on a very strategic level. And the NFO of this fund is currently live. It'll be on till the 27th of this month. So be there for that.
Sure. So how many stocks will there be in the underlying index here?
Yeah, so essentially the fund will have 15 stock portfolio. And basically the because this is a passively managed fund, there is no active involvement about what stocks to buy, what stocks to sell. Our job as, asset managers is to replicate the index as closely as possible. So the methodology is something that Nifty decides, Nifty NSE indices.
Sure.
And methodology is essentially a company that is a part of SIDM, which is Society of Indian Defense Manufacturers. So
Mhm.
the company has to be registered under SIDM, and the company has to have over 10% of its revenues coming from the defense sector.
Sure.
These are basically you're essentially buying companies that are pure play, mostly pure play defense. They have very strong allocation towards defense as an industry, and companies who are so essentially building us 15 stock portfolio in this sector. So that's how the stock selection works in this.
Sure. Sure. So the NFO closes on 27th June.
Yes,
Yeah.
that's
So,
right.
all right. So, Pratik, what do you believe is the growth trajectory for the passive funds and index funds in India, particularly? Because what we've seen is, of course, we have seen a good amount of growth in the index fund side, but the active, of course, has far higher momentum in its growth, etc. So, what do you believe is the growth trajectory for index, passive funds, ETF funds, and why do you believe so?
Yeah, I think growth trajectory is pretty much, passive funds have a much lower base. So, it's a much smaller part of the market, especially to take out the institutional flows. So we believe that the growth trajectory might be slightly higher because of the low base effect. But yes, in terms of the amount of money that's collected, passive is still a very small amount, maybe, less than maybe 15% of the overall
Sure.
money that's collected. So we believe that as a space, it's very new, it's very niche, and but we believe that it's growing at a very fast rate. Today, it's about 17% of the industry volumes in the industry AUM, and we
Mhm.
believe that this can easily go to 25-30%. So essentially, when you're looking at a segment where market share is growing, that means the growth is higher than the industry growth.
Yes, of course.
Essentially,
I
if the
agree.
industry is expecting to grow at 25, industry is looking to have a market share of 25-30% over the next 5 to 7 years time, then you're essentially looking at industry which is growing faster than the market. So I think that's where we believe where passive is. But overall, I think the equity as a general market is also, we believe is huge opportunities. And I think this space can become at least 3 to 4 times, in the next 4 to 5 years time. We believe that in our AMC industry, if you look at equity funds,
Hmm?
equity funds, if you don't have any net, if you don't add any new money, you will still grow at 15% a year. So and I think if you're growing at say 20, 30, 40%, then you can expect overall AUMs to grow by about 30, 35%, which is what we've seen in history. Plus, also, overall, there's a lot of interest that's coming in from foreign investors. India is the hotbed of growth today. So I think a lot of interest from foreign investors, domestic investors also looking at equities very strongly. We talk to a lot of family offices and institutions, and if you ask them 10 years ago, most 95% of them would be primarily fixed income, liquid
Mhm.
fund types. And I think a lot of them, a good proportion of them are looking at allocating 10, 15, 20% towards equities. So I think you're looking at retail stepping up. You're looking at SIPs also increasing at a very big rate. You're looking at more penetration that's sort of happening. You're looking at global people allocating more towards Indian equity, and you're looking at the chunky sort of family office institutions who are looking at, and these guys are what, thousands of crores who are allocating,
Yeah.
going from zero to
Mhm.
say 20-30% allocation. So overall, the sort of opportunity that we have is quite intense. And
I,
obviously the best part is that it doesn't matter about the opportunity. Ultimately, the companies have to perform. I think if the underlying companies who invest in don't perform, then obviously money won't come in. So I think the best part about Indian equity market is that the underlying companies are investing in are growing at a very fast rate. Cash flows are very strong. So I think that is what's going to lead to the money that is on the sidelines coming in.
Sure, sure, sure. So when we look at Motilal Oswal Mutual Fund, you have a very, very good blend of the active as well as uh, passive funds, right? So could you provide some, highlights about the various index fund categories you have, etc., at Motilal Oswal Mutual Fund?
Yeah, absolutely. So, passive funds, we crossed a big milestone 2 days ago where we crossed 25,000 crore in assets. So I think we're growing very quickly. This was close to
Congratulations for that.
Thank you. This was close to zero about 4.5 years ago.
Right.
So category that has I mean it's been better than expected in terms of the growth that we've had. Unfortunately, and this is despite closure of our international funds about 2.5 years ago. So that was 80% of our AUM, and that if you added if those who opened, then our AUM would have been maybe double of today. So I think a lot of our focus is now on domestic, which is where also demand is coming in. But essentially, our we have a very large passive business. We have the largest number of funds in the country, about 35. And our strategy is building blocks for asset allocation. So we want to have a fund in each category. We also want to only launch funds where we see long-term opportunity for wealth creation. So, defense, we could have launched, a lot of different thematic funds. But the reason why we chose defense is because as a house, we are very bullish on defense. A lot of these stocks that are in this fund are already owned by us in a lot of our other actively managed funds. So, as a house, we're very long-term positive, and we believe that this sector has a lot bigger role to play in the long run. So I think that's what where we are. We were the first one, and I think what's really unique about MOMC is that we are the most innovative AMC, I would say, when it comes to launching new funds. We were the first ones to launch Nifty mid cap, small cap, multi cap. First ones to launch factor funds. First ones to launch international funds, where we're number one today,
Mm.
and also the first ones to launch thematic funds today, where we have a lineup of thematic funds we're launching. So I think. Where we really believe in innovation, we really believe in staying ahead of the curve, and again, wealth creation is very important. Ultimately, whatever we do needs to ensure that we create wealth for our customers. So a lot of the selection process happens that way.
Sure, sure, sure. No, I totally agree with you. And you mentioned about factor. So that was factor. I was about to ask you that factor, when you look at factor investing, it's clearly becoming very, very important part of the index funds bucket now. So could you tell us something about the factor model which you have created at Motilal Oswal?
Yeah, so factors are very interesting. Factors, in fact, as a category, if you look at globally, it's the second biggest category in the world after broad-based funds like your Nasdaq, S&P types. The second biggest category is factor funds, and I think we're seeing very early days, but the offtake that we see in factor funds is quite large. Factor funds offer the opportunity to outperform while keeping costs low. So it's in between active and passive investing, where you have the cost and the strategy associated with the passive fund, which is very rules based, but you also have the ability to outperform, when it comes to active funds. So it's sort of in the middle. We and all the factor funds that so the four most important, so I think the world's most, I would say, prominent factors are value, quality, low vol, and momentum. So we have all four funds, and all four have historically outperformed broad-based indices like the Nifty 50. Again, all four are very different. So the idea behind factors is that you use. So if you're a stock picker, we believe that everyone uses some factor to select stocks. Whether you choose. So if you use something like price to earnings, price to book to pick stocks, you are a value investor. If you are looking at growth rates, if you're looking at stock price movements, you're a momentum type investor. If you're looking at stuff like ROEs or profit margins or debt to equity, you're a quality investor. So essentially, what factor investing does is that it takes this entire fund management process and gives it to you in a very simple passive fund, which is again very rules based. So and I think what it does is it simplifies active stock picking into these funds. So we believe that these are excellent funds for anyone looking at investing into these strategies. And I think all have done extremely well in terms of performance.
For sure, it's very, very insightful. And I think very rightly, the models, the factor investing is actually really gaining a lot of momentum as
Yeah.
are witnessing it as well.
Yeah, so also factors are very easy to understand.
Right.
I think if you look at the best, so there's obviously two types of I think when you look at factors also, you're looking at selecting a strategy that works really well across different market conditions. For example, the most popular factor in India is momentum, and
Mhm.
essentially in momentum you're buying stocks that have the highest price momentum in the last 6 to 12 months time. It's a very simple way to select stocks. If you're buying a value fund, you're essentially buying a fund which has the lowest valued companies in India. You're buying a quality fund, you're buying the companies that have the highest quality in terms of your debt to equities, price ratios, and all of that. So essentially, it's a good way of buying filtered stocks into your portfolio that you are extremely bullish on, and and does it a very systematic and low cost way. So we believe that it's a good way to get exposure in your portfolio.
Absolutely. Completely agree with your thoughts. So, Pratik, when we look at index funds in particular, uh, what the observation has been, like which I had said earlier, that the individual investors, primarily being driven by advisors as well as the mutual fund distributors, are not having the right share in their asset allocation process. So, through this in conversation by Advisor Coach, what message would you like to give to the advisors as well as mutual fund distributors, particularly when you're looking at index funds as being a very, very important part of their asset allocation process for the long term?
Yeah, so I think I mean my obviously, I think asset allocators, fund managers, distributors, honestly, we've seen more and more traction happening with our partners than traction coming in from direct investors.
Mm-hmm.
When we first started the business in 2019, 85-90% of the flows were happening directly from customers who want to buy a Nifty 50 or a 500 or a small cap. But today, about 70-75% of the money is coming in through our partners.
That's
So we
wonderful to
believe
know.
that the acceptability of index funds have grown significantly in the last 5 years.
Mhm.
We have thousands and thousands of partners who are currently allocating towards index funds, ETFs, and that number grows every day. So we believe that the acceptability of index funds has risen dramatically, partly because customers are asking, but partly also we believe that in terms of asset allocation, it makes sense to allocate some of your money in index funds.
Yes.
We believe that there is no fight between active and passive. If you look at the US portfolio, most people have a combination of active and passive. And we are not saying that active is better or passive is better. The idea is to have an allocation. If a customer is willing to build a portfolio, then maybe 20-30% of that portfolio can go to a simple, low cost passive fund or a factor fund that will do very well over 5, 10, 15, 20 years. So they don't have to worry. And then you can use and then you can use passive funds for your satellite portion where you want to optimize returns for the next 3 to 5 years time. So I think a combination is what the world has adopted, and I think India is still a bit slow, but we believe that increasingly more and more advisors are adopting passive for their clients' portfolio. So we believe that there is some growth there. We also believe that in passive you're able to play more than just more than just your vanilla products like flexi cap, multi cap, mid cap. Passive, you can play commodities, which has now become a part of
Mhm.
people's asset allocation. You can pay fixed income through GSEC funds, which are very safe.
Yeah.
You can play international funds like S&P 500 and Nasdaq. You can play factor funds, or you can play thematic funds like defense. So I think the sort of options that you have with passive in terms of your people used to say that with passive, how do I show expertise?
Mhm.
I mean, you can show expertise through your selection of whatever theme or whatever sector you think is doing very well. You can show expertise by having the right factor fund in the client's portfolio, and so I think and so I think overall I think it's a good place to add innovation to client's portfolio. It's a good way to add your core allocation to people's portfolio. So we believe that more and more advisors are doing this, and this trend will only continue.
Wonderful. I totally agree. And could you also throw some light in terms of, the global market size for the passive funds?
Yeah, so globally, passive funds are also very large. If you look at the US market, which is the largest, about 55-60% of the mutual fund industry is
Mhm.
passive.
Mhm.
You're there, obviously, it's a very efficient market. So,
Yeah.
there, to be honest, alpha generation is still very difficult,
Yeah.
which is why a lot of people tend to choose passive for most of their portfolios.
Right.
I think, unlike the US, in India, we still have some inefficiencies. It is possible to outperform. Fund managers still have a decent edge out here. So we believe that unlike the US, I think India is still a very combination of active passive sort of a market. Passive should be an allocation, not a decision. Whereas the US, I think it's pretty much become a decision.
Right.
So very different markets. We believe that India still has, and plus India has a lot of small cap, micro cap, where there is room for stock picking. There's not a lot of analyst coverage. So I think given the inefficiencies, I think there is room for both styles to flourish and do very well over the long run.
No, I totally agree with you. Given the inefficiencies in the markets here, active and passive, of course, both are here to stay collaboratively together. Well, very, very insightful, Pratik, interacting with you today. And, our best wishes for Motilal Oswal Nifty India Defense Index Fund, which closes on the 27th June. And so nice to have a wonderful conversation, very, very insightful about how, the factor investing as well as the passive, the ETF and the index funds. Thank you very much for taking our time today.
Thank you for having me on the show, and I look forward to doing more of this in the future.
Absolutely. Look forward. Thank you very much.
Thank you.